Today's topic, I'm going to try to educate you on leveraging annuities for retirement, specifically for income. So I'm going to discuss what is an annuity, why somebody would ever leverage an annuity for retirement income purposes, and then the three main areas on how somebody could utilize an annuity account for some sort of income related strategy to accomplish some sort of income related need. So that's going to be going off of annuitization versus an income rider versus just taking systematic withdrawals. What are the problems with annuitizations? What are the problems with income riders? What are the problems with taking it from systematic withdrawals? And then also, what are some solutions? What are some little areas that you could really leverage in any of those three areas of annuitization, income riders, or systematic withdrawals? So, make sure to take down notes as you're reviewing this video. If you have any questions, you want help regarding your specific situation, feel free to give our 1-800 number a call. That's 1-800-566-1002. So in its most basic explanation, what is an annuity and why would somebody utilize that for retirement income needs? An annuity is a type of account that's offered through an insurance company. So you could use this through IRA monies, meaning monies that you took from your 401k and you roll it over into a traditional IRA. You could create that traditional IRA within an annuity chassis, essentially. You could utilize this with Roth IRA monies. So let's say if you've already accumulated Roth monies and you want to take a portion of this and place it into an annuity, you would basically have a Roth IRA annuity, or you could utilize non-qualified monies, meaning post-tax monies that you're going and let's say you're taking from your checking, your savings account, you just sold a house, you just sold a business, and you have this money basically sitting in cash. You could go and basically fund an annuity that way. Now, what would be the purpose of doing so? And by it being offered through an insurance company, it's producing some sort of longevity insurance. It's letting the individual know that if they place X amount of dollars into this account, that they're going to be able to receive lifetime income from that account. So first I'm going to explain what is annuitization and examples of that and how that was how old-fashioned annuities essentially worked versus the newer age, really after 2000. In early 2000s, you had something called income riders that came out that allow somebody to still have lifetime income but have that flexibility. So regarding annuitization, in that example, we understand that if the person gave $100,000 to the insurance company and they triggered annuitization on it and they were receiving $10,000 per year to the day they passed away, if they live past that 10-year mark, they're in the green. They're basically dipping into the insurance company's pockets every single year past that X point, past that break-even point. But if they passed away prematurely, and let's say this individual took it in the form of single life income as an example, and they passed away after a couple of years because they came down with some sort of ailment or had some sort of accident, and let's just say they passed away after 2 years, they would have received $10,000 the first year. They would have received $10,000 the second year, $20,000 of total cash flow, and then passed away. Well, that $80,000 of the difference between what they received versus what they paid out, that $80,000 is now going back to the insurance company. So individuals that said, I understand I'm rolling the dice here. I don't like that concept of not leaving any sort of death benefit to my beneficiaries. I don't like the concept of annuitization, but they're kind of caught between a rock and a hard place because it's at least giving some sort of longevity insurance to say, I know if I'm putting X amount of dollars here, I'm going to be receiving that $10,000 income need, and I have an insurance behind it because through the insurance company, utilizing their law of large numbers and actuarial data, that they're going to produce me that $10,000 of cash flow every single year. So that's obviously the good thing. The downside is if the person passes away prematurely, all those monies would get left back over to the insurance company, and you also forked over $100,000 to the insurance company. So now you cannot reinvest those monies. It's basically, you're sitting in that contract and you're just waiting for income each year. So that's how annuitization and old-fashioned annuities work. So when we talk about the basic components of an income rider, what it's doing is giving that individual cash flow, lifetime income streams. But if they pass away prematurely, there's still an account balance there that's going to be left over to the beneficiaries. So you're using the rider for lifetime income, but if you drain that well dry where you have a $0 account balance, you still have lifetime income payments coming to you. If, let's say, in that example where the individual was receiving $10,000 per year and then passed away after 2 years and there was $80,000 sitting in that account balance would be left over to beneficiaries. In addition, the account balance is going to be synced with some sort of crediting strategy. So if you have a fixed annuity with an income rider, you have a fixed interest rate that's going to go into that account balance every year. Yes, the account balance is going to get depleted anytime that you're receiving income and also what the income rider is, but you could also have some sort of fixed rate of return as well that could potentially be higher than that, or at least slow down the process of draining that well dry very quickly. The other aspect would be a fixed index annuity. And typically the fixed index annuities are going to have the most powerful income riders. And what that does is your interest credit is either going to be positive or it's going to be 0%, and that's on your physical money. So your account balance will get depleted by the income that you're receiving, the income rider fee, if there is an income rider fee, because some of these accounts have income riders that are built into the account, meaning that you have no income rider fee. And then if there was no growth that year, that's what will start to deplete the bucket. If, let's say, there's growth and you're receiving 7% cash flow or 7% of income from your account balance, but you received a 10% rate of return onto your monies, you could have a positive 3% spread in that example that's going to grow your bucket that much further and basically allow you to have growth on your monies while producing that lifetime income stream. But don't get too excited about that component. Really, the main reason why somebody would leverage an account with an income rider is going to be for max cash flow. And I'm going to show you a couple of different examples on how you could back up into the math. But the most important aspect is if you're trying to use an annuity for income, or you're trying to use some sort of account for income, make sure that you're using the number one account and you're leveraging the max cash withdrawal strategy so that you're able to put the smallest dollars and only as much as necessary in there. So what I mean by that is, let's say if you have company ABC and they're giving an offer of $10,000 of income, but it's going to require $130,000 of a deposit with company ABC versus company XYZ is going to be producing that same $10,000 of income, but it's going to only require a deposit of $90,000. They're going to be able to produce that same $10,000 of cash flow. It obviously made more mathematical sense to go into the superior product as opposed to the inferior, rate of return, the inferior cash flow. That's saving this individual $40,000 in that process. So the kind of the problems that individuals come into is you have hundreds and hundreds of different offerings. So by trying to cherry pick the correct offerings, they typically fall into 5th place, 10th place, 20th place off of what could just be the number one option or the number one or number two options. And it could result in thousands of more dollars in your pocket that you don't have to place into an annuity for that lifetime income stream. You're saying, okay, my income gap is X amount of dollars, 10,000, 20,000, whatever that is. This is because I'm using the top rated account, the top rated cash flow. It's going to allow me to put less dollars with this top rated one as opposed to falling victim to the inferior product, which is going to result in me having to place more dollars in there. This is all about controlling the chips. It's all about using the smallest dollars only as much as necessary towards that correct component so that you could utilize the annuity as a cash flow strategy. So you're saying, okay, when I hit my retirement years, I'm receiving Social Security income. I may be receiving pension income or rental income or whatever that is. Then I also have a baseline of lifetime income being generated from my annuity as well, so that the combination of these income streams is going to be greater than or equal to what my expenses are. And that's how you're able to have peace of mind in retirement. Third way on how somebody could utilize an annuity for an income related strategy is by taking out withdrawals. So this was something that was very popular in the 1990s, and a lot of individuals also leverage this with bank CDs, known as a laddering strategy. They could use it with fixed annuities, you could use it with fixed index annuities. And ultimately what's happening is it's based on the interest rate environment. So for the individual that says, okay, I want to place monies aside into something, I just want to live off what the interest is each year, and I know that I could get 5% as a fixed rate of return, I do not want to have my money susceptible to any downward market losses. I do not want to have my money susceptible to any fees. I feel confident that by placing my money in here, it's going to give me that consistent, 5% as an example, and that will be able to handle that individual's cash flow. So in that example, let's say that somebody puts $100,000 in with a 5-year fixed annuity that's paying 5%, and their income gap need was $5,000 per year. So they know that every year they're generating interest of $5,000. They're able to take the $5,000 that they're generating interest on and basically utilize that towards some sort of cash flow related need. After 5 years, they could take the $100,000 and then purchase a new 5-year account or 7-year account or 10-year account or whatever that is. So they're always getting that fixed rate of return. When I'm talking about the laddering strategy, what happens and what individuals did with bank CDs in the past is they would leverage a 1-year, a 2-year, a 3-year, a 4-year, and a 5-year. So maybe the 1-year bank CD was paying, 10%, and the 5-year bank CD was paying a rate of return of 12%. And then you had, 2% was 2-year CD was paying 10.5, 3-year was paying 11, 4-year was paying 11.5. So what they would be able to do is say, okay, if I go and I put $100,000 in each, I'm having an aggregated total of right around an 11% rate of return from some sort of cash flow. I'd be able to take out this income in the form of, or the interest in the form of income. Anytime that my 1-year CD comes due, I'm just going to purchase a new 5-year CD. So that after the first year, my 5-year CD has 4 years left. My 2-year CD has 1 year left. My 3-year CD has 2 years left. My 3-year CD has 2 years left. So basically, they would just constantly be repurchasing a new 5-year bank CD, or you could do that with fixed annuities. Because fixed annuities typically offer a higher rate of return than bank CDs, you're able to get a higher interest and be able to utilize a higher cash flow by using the insurance company and their fixed rates with that sort of withdrawal related mechanism. So that's something that was very popular in the 1990s. Then when you had a large drop in interest rates, that kind of went by the wayside. And now because interest rates have been increasing, an individual could still leverage that sort of strategy if they just want to have that peace of mind that they're not dipping into their principal, that they're just living off the interest. They could utilize that specific strategy. So you understand the concept of how annuitization works, how income riders work, and then also how withdrawal strategies work. What are some of the negatives, and then what are some of the benefits, or what are some accounts that are offered whenever you're trying to look for what the best route would be for your income solution. So if I use an example to explain this better, let's say if we have an individual that's currently age 64, he's looking to retire at age 65, so a 1-year deferral. Currently, or at age 65, his ideal retirement date, he's going to be collecting $30,000 from Social Security income, $40,000 from pension income. And then after doing his budgeting analysis, we understand that he has $80,000 of an expense need from age 65 until date of death. He has an IRA that he saved up from old 401k monies and monies that he placed in contributions of about $600,000. If we're trying to figure out, okay, what is his income gap, we have to look at what his cash flow sources are going to be once he hits his ideal retirement date. We understand that his lifetime income cash flow is going to be the Social Security income at $30,000, the pension income at $40,000, but his expenses are $80,000. So that tells us that there's a gap of $10,000. If rather than this person trying to invest these dollars and utilize a combination of growth-related strategies for an income-related play, he can say, okay, I have $600,000 accumulated. What's the smallest dollars and only as much as necessary that I need to put with the top annuity and the top annuity solution that is going to leave the rest of my monies on the sidelines? It's going to leave the rest of my monies for emergency needs, for growth-related needs. So using the smallest amount of dollars, only as much as necessary, that's going to produce me this $10,000 of cash flow, and that's going to come to me for the rest of my life. So that if I'm receiving $10,000 from the annuity, that's going to give me level income. My Social Security income is going to give me income, lifetime income, and then my pension is going to give me lifetime income as well. And the combination between all three of those is going to be equal to what my expense need is. So now I can have fun with all those existing monies. If let's say by going through the top annuitization options, there's going to be a SPIA, single premium immediate annuity, or a DIA, deferred income annuity, maybe that would require, out of the $600,000, this individual has to put $130,000 into that sort of product or into that sort of account. So they would create an IRA with a SPIA or a DIA that would produce this $10,000 of cash flow. If you're looking at the income rider solution, maybe the top income rider, it's going to require that they put $100,000 with the top income rider solution, like a fixed index annuity with an income rider. And that's after waiting 1 year is going to produce this individual $10,000 of cash flow. Or if you have fixed accounts that are paying around 5% rate of return, we understand that 5%, the smallest dollars and only as much as necessary somebody has to place into that specific account to generate $10,000 of cash flow from a 5% rate of return would be $200,000. So all three of these could at least accomplish this person's goal, but the one that would make the most mathematical sense would be the one with the income rider or the one with the interest, if the person just wants to live off their interest and not have to dip into their principal. But if the goal in mind was to what's the smallest amount of dollars, use the smallest amount of dollars only as much as necessary to produce my income strategy, produce my lifetime income stream, so that now I could have my leftover monies sitting in my emergency need and sitting in my growth related bucket. What would that look like? And ultimately what they would do is take the 100,000 from the 600,000. They would transfer 100,000 with whatever that top rate was, whatever that top solution was. So now they have 500,000 remaining in their IRA. Maybe out of the remaining 500,000, they want to leave $50,000 into some sort of IRA money market account, something that's not going to be susceptible to downward market losses, something that they could access in case of that oh my gosh moment was to occur. So that's IRA number 2. IRA number 1 was going to be this income rider solution. Now, based on the 600,000 original, 100,000 went with IRA number 1, 50,000 went with IRA number 2. Now this leaves this person with 450,000 that they could create a combination of IRA number 3. And now this is where you could have fun with it. This is where you could utilize different growth-related strategies. So you could utilize mutual funds, ETFs, different growth-related stocks, maybe more speculative-related investments, maybe longer-term related accounts if you're not risk-tolerant and you're more risk-averse, so you want to have some sort of safety with a blend of risk in there. But what it does is it basically took one sort of IRA and you customized a portion of it, a sliver of it, into the top annuity-producing product. You did not just go to chance and say, okay, I'm just going to go and, I know that this company is kind of up the road and I'm just going to blindly go in there, because that could result in you having to place more dollars into that inferior product. With this sort of solution, out of the 600,000, it only required a $100,000 deposit with the top solution. And therefore you now have 500,000 that's left over as your fund monies. 500,000 that now you could basically utilize that towards some sort of inheritance maximization, some sort of growth maximization, and really have that flexibility there. So if we go slow with this example, and we understand that somebody could utilize old-fashioned annuities with their annuitization, they're either a SPIA, single premium immediate annuity, or a DIA, trigger that $10,000 of cash flow. Well, if it required $130,000 to place into that account, that's going to be worse. You're going to be basically forking over $30,000 more than what you needed to than the income rider play. On top of it, if let's say this person's taking single life only option and they pass away after a couple of years, their remaining account balance will get left over to the insurance company, not the beneficiaries. By going with that number 2 option with the income rider, they know that out of the 600,000, 100,000 is what was needed to create that IRA. Number 1, that's going to trigger $10,000 of cash flow, because it's going to have the mechanism of an account balance with the income rider. The income rider is going to generate cash flow for the rest of that person's life. So that's going to close up that $10,000 gap every single year till that person passes away. But if that person passes away prematurely, whatever's remaining in their account balance would get left over to beneficiaries. So that's why it would make mathematical sense to go with this option. A negative with using an income rider is, let's say if somebody just goes and they look at a couple of options, and they're going to the drawing board and they say, okay, you know what, I'm going to go and put my money with an income rider product, and they said that if they give if I give 200,000 with this company, they're going to be able to produce the $10,000 of cash flow. Well, in doing so, and they did not go with the superior option, that just cost this person extra 100,000 above what they needed to, because they did not go with what that top option was. So basically every cent makes a difference. every cent is more money in your pocket and less money to the insurance company. You want to be able to leverage the sweet spot. So if somebody's age 64 looking to trigger income at age 65, that's a 1-year deferral. There's going to be a whole slew, maybe 3 or 5 companies that have the absolute best sweet spot regarding that situation than another company that is for the individual that's age 64 waiting till age 70 to trigger lifetime income. There could be 3 or 5 other companies that are significantly better for that situation than the 1-year deferral. So it's all about using the math and making sure that you're not going into it blindly. That's where we help out individuals on a national basis. And this is what really separates us from other advisory groups, is by understanding how these mechanisms work, understanding how to use the contract against itself to make sure that you're placing the smallest dollars only as much as necessary. You're using max withdrawal strategies that other advisory groups do not have access to, and also proprietary products that other advisory groups do not have access to. At the end of the day, what that means is you're able to keep more money in your pocket, use less money into an annuity, while still having that peace of mind that you're going to have that longevity insurance, receive lifetime income for to the date of death. If you pass away prematurely, at least your beneficiaries are going to be receiving something. You didn't just throw all that money away to the insurance company, and at least give you access to that flexibility. So that's where there's some negatives with those income rider related accounts, and that's a common mistake that individuals make. They'll go into the 5th place option or the 10th place option out of 900 offerings, thinking, okay, that was a good solution. But by going with the top 1 or 2 options, that could save you thousands and thousands of more dollars, or give you thousands of more dollars throughout retirement from a cash flow perspective. And then lastly, the withdrawal strategies, you want to make sure that you're going with something that will produce the highest fixed option, or the highest fixed indexed account option with the highest potential growth, so you could utilize and take out the highest amount of withdrawals from that if you never want to dip into your principal and you only want to live off the interest. So obviously going into an inferior product on the withdrawal strategy, that could be a problem. Just by going into an inferior product on the annuitization option, that could be a problem. Going to the inferior option on an income rider aspect, that could be a huge problem. If you found value in this video and you'd like to speak with an advisor or speak with a specialist, feel free to give our 1-800 number a call. It's 1-800-566-1002. Annuity planning could be very tricky, could be very complicated. That's one of the things that separates us from other advisory groups throughout the country, is by understanding if you like the concept of that longevity insurance and you want to have that peace of mind that you're always receiving some sort of lifetime income cash flow for either yourself or you and your spouse, which one's going to work best for IRA monies versus Roth IRA monies versus non-qualified monies. And you want to know the ins and outs and really figure out whether or not it does make sense, feel free to give us a call. We're available 24 hours a day, 7 days a week. And there's many times that an annuity is not right for an individual situation, where it may make more mathematical sense and more flexibility to leverage stock dividends, to leverage bonds, to leverage REITs or rental properties to produce that cash flow and close up that gap. So annuities can be fantastic solutions, or it could be complete disasters. You really want to understand the pros and cons, and that's what we try to do, is educate you guys. And I hope that this video has at least helped you in some way. Also, feel free to subscribe to our YouTube channel, Retire Sharp, so you could have access to the most updated videos. Thanks so much, guys.